Hey everyone. So you've probably seen the headlines. Indian IT stocks have been getting absolutely hammered. TCS down, Infosys down, Wipro down. The whole Nifty IT index just erased roughly $50 billion in market value in February 2026 alone. Yes, $50 billion gone in 1 month. And the question everyone's asking is this the beginning of the end for Indian IT? Today we're going to go really deep on this. Not surface level stuff, not just the news. We're going to talk about what's actually driving this, what the data from earnings calls says, how Indian IT companies are responding, and what scenarios could play out over the next 12 to 24 months. So grab your chai, sit back, and let's get into it. What triggered this crash? Okay, so first things first, what actually caused this sell-off? 2 words, AI anxiety. Now, AI anxiety is this growing fear among investors that generative AI tools like Anthropic's Claude, Palantir's platforms, and other agentic AI systems are going to automate the core work that Indian IT companies have been doing for the last 30 years. What is that core work? Basically, writing code, testing software, maintaining applications. That's what we call ADM, application development and maintenance, and it has been the bread and butter of this industry forever. And here's the thing that really spooked markets. Anthropic launched something called Claude Cowork, an AI agent specifically designed to do the kind of collaborative software work that a junior or mid-level developer does. When that landed, investors connected the dots very quickly. If an AI agent can write code, test it, and maintain it, what happens to an industry that employs millions of people to do exactly that? The Nifty IT index dropped 8.2% in a single week in mid-February 2026. That's the steepest weekly fall in 10 months. And there's a second layer to the story: macro headwinds. The US Federal Reserve hasn't cut interest rates as expected because employment data in the US remains strong. When rates stay high, companies in the US, which are the biggest clients of Indian IT, get cautious about spending on discretionary tech projects. So you have AI disruption, fear on one side, and tight client budgets on the other. A double punch. The pricing shock nobody's talking about enough. Now here's something I think is not getting enough attention in mainstream coverage. It's not just that people are worried about AI. Something very concrete and very tangible is already happening in the market. Clients, big banks, insurance companies, retailers are walking into contract renewal meetings and saying, "You told me AI makes your people 30% more productive. So give me a 20 to 30% discount on my bill." And we're not talking about small discounts here. According to earnings call data and industry reports, clients are demanding 20 to 40% price cuts on traditional service contracts. That's a massive compression. Think about it this way. Imagine you run a taxi service, and now Uber comes along. Your customers say, "Hey, Uber costs 30% less. Match that or I'll switch." That's the position Indian IT companies are in right now with respect to AI. Clients know AI exists, they know it boosts productivity, and they want that benefit in the form of lower prices. So what you get is what analysts are calling a deflationary air pocket. Revenue from old-style billable hours work starts shrinking, while new AI-driven revenue hasn't fully kicked in yet. You're kind of in between two business models, and that's where the pain is coming from. The FY26 revenue growth guidance for the sector? A very muted 4 to 6%. For an industry that used to clock 10 to 15% growth regularly, that's a significant reset. But wait, is Indian IT actually dying? Okay, so at this point you might be thinking, wow, this sounds really bad. Is Indian IT just over? And this is where I want to really slow down and think carefully, because I think the narrative in the market is swinging too far in one direction. Let me give you a very important counter-argument. Enterprises cannot just turn on AI. It's not like flipping a switch. You need massive integration work, data governance frameworks, cybersecurity architecture, and change management. Who does all of that? IT service providers. Indian IT companies. So here's the fascinating paradox. The AI revolution actually creates enormous work for Indian IT, even as it disrupts some of their legacy revenue streams. And we're already seeing evidence of this. TCS, India's largest IT company, reported $1.8 billion in annualized AI revenue, growing at a remarkable 17.3% quarter-on-quarter. That is not the number of a company being killed by AI. That is the number of a company riding AI. Infosys, on the other hand, told us something equally fascinating. They are actively working on 4,600 AI projects and have generated over 28 million lines of code using AI tools internally. So Infosys isn't a victim of AI. It's an active participant in the AI economy. The real story is, the old model is dying, yes, but something new is being born. And the question is not whether Indian IT survives, it's who survives and how fast they can make the transition. The business model is transforming. Now let's talk about what that transformation actually looks like, because this is really interesting. For decades, Indian IT ran on what's called the FTE model, full-time equivalent. Basically, you send 500 engineers to a client, you bill them for 500 engineers every month, and you grow by hiring more engineers. Simple, scalable, but very dependent on human headcount. That model is now being replaced by something called outcome-based pricing or agentic pricing. And this is a fundamentally different way of doing business. Instead of saying we'll give you 500 engineers, companies like Infosys and HCL Tech are now saying, we'll give you the outcome, say a 30% reduction in your IT support tickets, and we'll charge you based on that value delivered. The AI agents and the human engineers work together, and the client pays for results, not hours. This shift is also visible in the workforce data. Look at a company like Persistent Systems. They grew revenue 17.3% in dollar terms year-on-year, without a proportional increase in headcount. That's what analysts call non-linear growth. Revenue growing faster than people. That's the new model in action. And then there's Coforge, which grew a stunning 21.5% in constant currency, partly through their acquisition of a company called Encora, which is helping them do AI-led engineering at scale. Meanwhile, TCS is making a massive infrastructure bet. They're investing $5 to $7 billion to build 1 gigawatt of AI data center capacity and launching their own AI platform called Wisdom Next. Infosys has its Topaz platform and something called an agentic foundry, essentially a factory for deploying AI agents at enterprise scale. These are not the moves of companies that are throwing in the towel. These are the moves of companies that are betting their future on leading the AI transition, not being run over by it. The workforce story. What about jobs? Now I know many of you watching this are either working in IT or have family members who do. So let's address the jobs question directly. AI is enabling productivity gains of 25 to 50% in software development, according to multiple industry estimates. That's significant. That does mean you can do the same amount of work with fewer people. But here's what's important to understand. This is not resulting in mass layoffs right now. What's happening is a restructuring of the workforce pyramid. Companies are reskilling people rather than replacing them. Infosys, for example, has already trained over 270,000 employees on AI tools and concepts. The nature of the job is changing. Junior developers who used to write boilerplate code are being repositioned as AI supervisors and prompt engineers and quality validators. The human is moving up the value chain, from writing code to reviewing and directing AI-written code. Attrition in the sector has actually declined, which is interesting. Companies aren't firing people en masse, but they are being much more selective about fresh hiring. The days of bulk campus hiring of 30,000 freshers a year may be over, or at least significantly reduced. Who's winning, who's struggling? The data. Alright, let's look at the actual numbers from Q3 FY26, because the divergence between companies is really stark. TCS posted 4.9% reported growth, with operating margins of 25.2%, and a massive total contract value, basically new deals signed, of $9.3 billion. That's enormous. TCS is the defensive anchor of the sector. Infosys had slightly lower growth at 1.7% in constant currency, but here's what I find really exciting about their numbers. 57% of their new deals are net new business, meaning they're taking work away from competitors or creating new categories, not just renewing old contracts. That's a strong sign of competitiveness. Wipro is the one that's struggling. Revenue actually contracted by 1.2%, and their large deal bookings declined year-on-year. They've launched something called Wipro Intelligence, but the market is waiting for execution proof. LTIMindtree is a nice recovery story, 5.2% constant currency growth, and their order pipeline jumped 6.4% sequentially. The merger of L&T Infotech and Mindtree seems to be delivering synergies. In the mid-cap space, Persistent and Coforge are the ones turning heads with 17% and 21% growth respectively. And in the niche space, KPIT Technologies, which focuses on automotive software, is pivoting to what they call AI-defined mobility, essentially embedding AI into vehicle software for OEM clients. The key takeaway: this is not a uniform story. Some companies are clearly navigating the transition better than others. The gap between leaders and laggards is widening. 3 scenarios for the next 24 months. Let me now walk you through 3 scenarios for how this could play out. I think this is more useful than just predicting one outcome. Scenario 1. The fast recovery 12 to 18 months. In this scenario, TCS and Infosys successfully ramped their AI revenues to above $2.3 billion annually. The BFSI sector, banks and financial institutions, which is already showing green shoots, comes back strongly. US Federal Reserve cuts rates, unlocking client budgets. The sector proves it can grow earnings under the new outcome-based pricing model. Margins start recovering. Scenario 2. The slow grind 18 to 36 months. This is the more likely base case. The transition happens, but it's bumpy. Pricing pressure persists for another 4 to 6 quarters. Revenue growth stays in the 5 to 7% range. A revenue grows but doesn't fully compensate for legacy pricing cuts. Companies that are agile survive and eventually emerge stronger, but it takes time. Scenario 3. Structural disruption, the bear case. Here, AI agents like Claude Cowork advance faster than expected. More work gets insourced into client-side global capability centers, what we call GCCs. The pricing discount demanded by clients jumps beyond 40%. And Indian IT's margins structurally decline to a new, lower level. This is the scenario the market is partly pricing in right now, and it's a real risk, but most analysts don't see it as the central case. The truth is, the catalysts for recovery are well defined. AI revenue monetization at scale, faster deal-to-revenue conversion, BFSI recovery, and US macro tailwinds. The question is timing. The valuation picture. Here's one more data point that I think is worth noting. The sector has derated, meaning the price-to-earnings multiple investors are willing to pay has come down. We're now at approximately 20 times one-year forward earnings, which is actually at or slightly below the 10-year historical average. What that means is investors have already baked in a lot of the bad news. They've compressed their long-term growth expectations for free cash flows from about 6 to 7% historically, down to 4 to 6% now. The market is saying we believe AI will permanently slow this sector's growth. Whether that permanent slowdown materializes, or whether these companies successfully reinvent themselves around AI, that's the big question mark hanging over the sector right now. Alright friends, so let's put this all together. Indian IT is not dying, but it is going through the most significant business model transformation in the last 20 years, shifting from a labor arbitrage model to a technology arbitrage model. That transition is painful, messy, and it takes time. The pricing pressure is real. The AI disruption is real. But so is the adaptation. The companies that are investing heavily in proprietary AI platforms, reskilling their workforce, and pivoting to outcome-based pricing are positioning themselves for the next chapter. And those that are slow to adapt, well, that's where the real risk lies. The numbers from earnings calls tell a fascinating story. $1.8 billion in AI revenue at TCS, 4,600 AI projects at Infosys, 21% growth at Coforge. This isn't a dying industry. It's an industry in metamorphosis. If you want me to do a deep dive on any specific company, TCS, Infosys, Wipro, or any of the mid-caps, drop a comment below and I'll cover it in the next video. If you found this useful, please give it a thumbs up, share it with someone in your network who's tracking the IT sector, and subscribe if you haven't already. I'll see you in the next one. Take care, everyone.